Do you see anything that gives you pause about the health and strength of the U.S. economy, which as of 2 weeks ago was rock solid?
Well, that's the irony of this whole thing. The economy of the United States and of most other countries of the world are going up. These economies are rising. GDP is rising almost everywhere. The employment picture is improving in the United States and many other countries. And we have synchronized growth in almost every major economy in the world. This is a very unusual and very positive situation when you look at it. The question that I think people in the market are asking, particularly in the United States, is if the economy is going up so rapidly and doing so well, why did we need additional fiscal stimulus? That, to a degree, can cause the economy to overheat. We're also seeing, at the same time, the Fed contracting a little bit, cutting back on its balance sheet somewhat. And I think people have anticipated higher rates, and that has been an environment which has caused an inflection point. We've gone from very, 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 very forthcoming monetary policy to somewhat more modest monetary policy here and probably abroad. That has sort of spooked the market, but it's been doing it because it thinks the economy is growing rapidly, and that's why Steve's chart's so interesting. What causes rates to go up? That's the key. If rates are going up because people think there's going to be more growth, then that should be good for the stock market, and the market's going to have to sort that out.
So, Bob, let me ask you this. I understand the stimulus that is embedded in the tax bill, which was something that had been talked about for years and years and years. The stimulus that came through in the last couple of weeks in the form of the spending plan feels to me sort of almost like an incidental stimulus. Let me just explain. Stimulus is stimulus, no matter how you look at it. But here, I don't know that both sides intended to stimulate the economy so much as the Republicans wanted to give more money to the military, and the price of that for the Democrats was to provide more money for domestic spending. So the intention was not to stimulate an economy that really needed stimulating.
That's correct.
Follow my point? Yeah.
I definitely follow your point. It's a very valid point. The goal of the tax cuts and the goal of the spending deal were not aimed so much at stimulating the economy. The tax cuts were aimed at giving corporations a benefit, and that was to provide for longer-term growth, more investment, and hopefully they would hire more people. And that was somewhat stimulative. I would say that was basically stimulative. The spending plan was basically a deal, money for the military and money for domestic programs. I don't think they were looking at it through a Keynesian lens of additional stimulus, but that is the effect. That's the effect of both. You have big tax cuts over a 10-year period, 1.5 trillion, then you have all the spending. So if you look at it from the point of view of the government's going to have to issue bonds to pay for this because it does provide for a higher deficit now and over the longer term. So the government will be in the markets borrowing more money, and it will be stimulative in an economy where we're already, for the most part, at full employment.
And I don't want to be a broken record, Bob, but interest rates doubled in 2012 and 2013 to 3%. They were higher then than they are now. We went a year and a half without having a 3% move for the equity market down. A year and a half, the all-time lowest volatility market in the history of modern American trading. And yet, in the last 7 trading days, we've had 2,000-point drops and 500-point turnarounds nearly every single day. Is that because interest rates moved 20 basis points?
No, it's definitely not because they moved 20
We got to
basis
stop
points.
with this interest rate story.
We got to stop. The interest rate story is really not the major story. If there is an interest rate story, it's not what has happened, but it's the fear, the anticipation that they'll go a lot higher. And that remains to be seen. We've had a lot of false alarms of people anticipating rates, the market anticipating rates going up, way up, and they haven't. So I think what the market's doing is the stock market's gone up a lot, and there's an anticipation that rates may go up a lot more than they have, and therefore that creates in the minds of people a sense that we may not have the supportive monetary environment that we've had in the past, and therefore when you combine that with an already very high market and a reduction in the support that monetary policy is giving the market, that causes people to be uncertain. But the rate increase we've seen so far has been modest, and certainly in historical standards, not something that should cause the markets to act as they have acted. It's more fear than the reality at this point.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.